Well, thank you for joining us at the weekly update. We're going to get right into it. First things first, the O'Hare Clay Shoot's coming up, the O'Hare Family Clay Shoot. We're very excited. It's out at Warren Valley. In just 2 weeks, the prize table is filling up. So is registration, by the way. If you haven't registered, there is a registration link down in the description. Make sure you go ahead and do that, and we'll see everybody out in the range. If you have questions for future installments, make sure to go ahead and ask them here. And this week's question, right? How do you explain why consumer sentiment is as bad as it is despite many positive economic indicators? How do those negative opinions impact the economy in the coming months if this continues? Great question. And there's been several allusions to this we've made over the last number of calls, and it goes even back to our initial market outlook this year. Consumer sentiment is bad. This is a chart of consumer sentiment. This is brought to us by the University of Michigan. They've been doing it now for almost 75 years. The green is where we are today, May of 2026. We're near all-time lows. Right? So to put that in all-time lows, and people would say, well, yeah, things are rough today. Look at some of the other previous all-time lows. February 75, you start the oil embargo. Right? 1980, you have full-bore stagflation taking hold in the economy at this point. October of 1990, that's when you get the recession that everyone was expecting based on 1987's numbers a few years earlier that actually finally came to fruition. November 2008, you have oil shooting through the roof. It's going to be $300 a barrel in no time. The housing crisis is in full swing. August 2011, the European debt crisis starts to unfold. People think that we're going to have a new normal of permanently lower growth for the entire world, and especially in the United States. June of 2022, the market's down 20%. We got 9% inflation. The Fed's raising rates on the short end of the curve. The Ukraine invasion's under full swing. Oil's going to be $300 a barrel in no time, and you won't be able to buy a bag of wheat. I mean, these are all very, very tumultuous times. And then you have today, where we're in the same boat. We feel about as bad today as we did during any of those periods. And in none of those periods were we hitting market highs, which we are seemingly every week right now. In none of those periods was the economy growing at 2% and consistently for basically the last few years. That's true today. Yeah, consumer sentiment might be permanently broken. People might just be permanently more pessimistic than ever before. This is also a representation of the larger percentage of people. This is 100% of the American consumer, and Americans are experiencing this economy differently. And what do I mean by that? This chart, this is the share of consumer spending by income group. Top 20% of wage earners are now 60% of consumer spending. And if you remember, we've talked about before, consumer spending is the vast majority of the U.S. economic system. Almost 70% of GDP is represented by consumer spending. Of that almost 70%, 60% is just the top 20% of wage earners. By the way, to be a top 10% wage earner in the United States, it's about $210,000 a year annually, which I would venture to guess is a lot lower than people instinctively think that it would be. But the top 10% own 85 to 90% of the outstanding value of the stock market. Although 60% of Americans do own some stocks, the majority is held by the people at the top. They're people in the top 10%, 90% chance they're going to own their homes. And there's something out there called a wealth effect. The wealth effect is when you feel wealthier, for whatever reason, you tend to spend more money. If your business is going well, you feel like you can splurge on something new. If your house has vastly increased in price the past few years, buying a boat doesn't seem like that bad of a stretch. If your portfolio has doubled in the last few years, as some people have experienced, many people have experienced, going on a nicer vacation doesn't seem out of the question. But that's at the top. That's relatively concentrated. However, as concentrated as that is, that top 20% is representing 60% of all spending. If you expand that out, the top third of wage earners, you're talking about almost 75% of all spending is done by just the top third of American wage earners. So that's an outsized number. It's relatively compact. This is a great chart. So Bank of America obviously has a bunch of credit cards. They do a big analysis on what people are actually spending more money on. This is what we're looking at. The lower third are spending about 3% more, right? That's the year-over-year numbers for January, February, March, and April. Middle income spending a little bit more, but the highest earners, which we already talked about, are the biggest impact because they're the greatest percentage. Their increase in spending is even higher. April, year over year, the higher end American consumer, which is represented probably 75% of all spending, spent 6% more than they did last year. Why do you think earnings have been revised up for many companies? This is the consumer spending is still coming through. It's relatively concentrated from people at the top, but it is still continuing. And that's a very different effect than the entire economy is experiencing. And what are they spending on? The answer is discretionary spending. That's what we're seeing. They're spending on things they want to be spending on. If you look at this chart, again, this is lower, middle, and higher, except now the lower is the blue, higher is, or the middle is the red, and higher is orange. On travel, first chart there, higher income earners are spending 10% more on travel this year than last year, 8% more on clothing. Everybody's spending more on general merchandise, but the higher incomes are spending even more. Restaurants, it's the same story. Durable goods is the only one where people seem to be, sort of holding steady or cutting back a little bit. But the discretionary income is following through. So when do these two things meet? Probably when there's a major disruption. When you start to feel the wealth effect fading away, you're going to see more of that consumer sentiment maybe go together. But right now, it seems to be a little bit separated. The overall underlying economy for the people that are spending more money has been very, very good. To every American? No. It's part of the reason we talk about the K-shaped economy. Are there always parts of the market that are not doing well? Of course. There are always parts of the market that are doing well. To 2008, yeah, housing was down, and we all remember that as a terrible period, unless you were in the oil business and oil was suddenly $150 a barrel. You had a very different experience during that period of time. And that is always true. There is almost always some sector of the economy that's not doing as well, and some sector of the economy that's doing much, much better than just about everything else. Right now, we're seeing that fairly concentrated at the higher end of income earners, which in the long run comes with its own set of problems and its own set of solutions. But does it slow down our thesis for the next few years for the economic system? No. What do you need to get to change that? You need a big upset in the wealth effect, probably to slow that down. And until we see that, or start to see some cracks at the edges, we're pretty sure our economic outlook remains the same. We're going to grow at about 2.1, 2.2% this year, despite all the turmoil we've had, despite the bombing in Iran, despite all the other geopolitical headlines. The average American consumer, as a percentage of the overall spending, is feeling relatively good. So with that, I'm going to recommend our book. If you can, again, check that out in the description below, 1929 by Andrew Ross Sorkin. You can watch the video on our review there. And thanks everybody for joining me this week, and we'll see everybody next week.